In 2020, a Chinese coffee chain became one of the most notorious fraud stories on Wall Street. The U.S. Securities and Exchange Commission said Luckin Coffee agreed to pay a $180 million penalty to settle accounting fraud charges. The complaint alleged that the company fabricated more than $300 million in retail sales. By every normal rule of business, this company should have died. It was investigated. It was punished. It was delisted from Nasdaq. Its name became tied to one of the biggest accounting scandals involving a Chinese consumer company. And yet, a few years later, the story looked completely different. By the first quarter of 2026, Luckin reported nearly 12 billion yuan in quarterly net revenue, 93.1 million average monthly transacting customers, and 33,596 stores at the end of the quarter. In the same period, Starbucks China had 7,991 stores. This is not a simple redemption story, and it is not a story about a Chinese company defeating an American one. The real question is more uncomfortable. How did a company that lost the trust of investors turn itself back into a daily consumer habit? This is the story of Luckin Coffee's second life. At the beginning, Luckin was not really selling coffee. It was selling growth. Starbucks built its China business around the idea of the third place, a cafe where people could sit, work, meet, and spend time. Luckin chose a different battlefield. It focused on speed, convenience, app orders, coupons, pickup counters, and dense store coverage. The customer did not need to sit down. The customer just needed to open the app, use a coupon, place an order, walk to the nearest store, and leave with a drink. That made Luckin look less like a traditional coffee house and more like an internet retail system wrapped around coffee. For investors, the numbers were exciting. More stores, more users, more orders, more transactions, more frequency. The story was simple. China had a huge coffee market. Starbucks was expensive and slow, and Luckin was building the faster, cheaper, mobile-first alternative. But there is a dangerous side to a growth story. Once a company teaches the market to value it for speed, it becomes trapped by that speed. If real growth slows down, management has two choices: tell the truth and disappoint the market, or make the numbers look better than they really are. Luckin chose the dangerous path. In 2020, the growth story broke open. The SEC's allegations were direct. Luckin was accused of using fabricated sales transactions to materially misstate revenue, expenses, and net loss. The numbers were not small. A $180 million penalty, more than $300 million in fabricated retail sales, more than $190 million in inflated expenses. This was not a difference in accounting interpretation. This was not a misunderstanding about a fast-growing business. It was financial fraud. And the Chinese record matters too. China's Ministry of Finance later disclosed that Luckin's domestic operating entities inflated 2019 revenue by 2.119 billion yuan and inflated profit by 908 million yuan. The China Securities Regulatory Commission also published investigation and enforcement updates. So this cannot be framed as only an American regulator attacking a Chinese company. Public records on both sides pointed to the same core fact. Luckin's financial fraud was real. That has to be said clearly, because the comeback does not erase the fraud. The value of this story is not in defending what happened. The value is in understanding the harder question. After a company is punished by the market, why does the business underneath sometimes survive? After the scandal, the damage came fast. Luckin's share price collapsed. Its reputation collapsed. Executives were removed. Investors sued. Regulators stepped in. The company was pushed out of Nasdaq and into the over-the-counter market. If you only looked at the capital markets, Luckin looked finished. But business can be brutally practical. Investors can stop trusting you. Regulators can punish you. The media can turn your name into a warning sign. But if customers are still ordering, stores are still making drinks, and the supply chain is still moving, the company still has a pulse. That is the strange part of the Luckin story. It lost the confidence of the financial market, but it did not immediately lose the consumer habit it had built. Most ordinary customers were not reading filings every morning. They were asking simpler questions. Is there a store nearby? Is the drink cheap enough? Can I get it quickly? Does the coupon still work? Luckin's second life came from that gap between investor trust and consumer behavior. Its comeback was not built by saying sorry. It was built by getting transactions to run again. First, the store network. By the first quarter of 2026, Luckin reported 33,596 stores. That number matters because it shows the company was no longer just a capital market concept. It had become a massive physical network sitting inside everyday consumer routines. Second, high-frequency customers. In the same quarterly report, Luckin said it had 93.1 million average monthly transacting customers. Coffee is not a car. It is not a house. It is not something you buy once a year. The value comes from frequency. If a company can make millions of people buy a drink again and again, small tickets can become a very large business. Third, pricing and product launches. Luckin was very good at making coffee feel like a daily drink, not a luxury ritual. Coconut latte, limited collaborations, app coupons, the 9.9 yuan price memory, new flavors that spread quickly on social platforms. Each move looked like marketing. Together, they served one purpose: bring the customer back to the app and then back to the store. Fourth, the local Chinese consumption scene. China's coffee market did not simply copy American cafe culture. Many customers were not looking for a place to sit for 2 hours. They wanted a fast drink between work, school, commuting, delivery, and daily errands. Coffee was competing not only with coffee, it was also competing with milk tea, convenience store drinks, fast food beverages, and delivery platforms. Luckin understood that battlefield. It was not selling cafe romance. It was building a high-frequency beverage network. That is why the company survived the scandal. Not because the scandal was minor, it was not, but because the transaction system eventually became real at scale. This is also why comparing Luckin with Starbucks can be misleading. Many headlines describe the story as Luckin beating Starbucks. That is too simple. Starbucks did not disappear. It still has a large China business. It still has brand value. It still represents a more premium, experience-driven coffee model. In its fiscal 2026 second quarter, Starbucks reported 7,991 stores in China. Comparable store sales in China grew 0.5%. Transactions rose 2.1%, while average ticket declined 1.6%. That does not show a company instantly destroyed. It shows a market whose rules have changed. For years, coffee competition in China was about location, space, brand, and lifestyle. Now the new competition is also about distance, speed, price, app engagement, store density, product cycles, and supply chain efficiency. Starbucks sells experience. Luckin sells frequency. Those two models are not perfect opposites, but they are different business logics. Luckin's real impact was not that it killed Starbucks. It helped shift China's coffee market from a cafe business into a high-frequency beverage retail business. That is where the pressure came from. But Luckin's second life does not mean the risk is gone. The first risk is price. Once customers are trained to expect coupons and low prices, the company has to keep proving that the economics still work. Low prices can build habit, but they can also compress margins. The second risk is store management. More than 30,000 stores is a powerful number, but scale also makes every weakness bigger. Product consistency, franchise relationships, food safety, employee training, delivery operations, and supply chain efficiency all become harder as the network expands. The third risk is competition. Luckin turned coffee into a high-frequency beverage network, but that idea is not impossible to copy. Cotti coffee, tea chains, convenience stores, fast food brands, and other beverage players can all fight for the same morning order, the same lunch break, and the same delivery window. The fourth risk is trust. Financial fraud does not disappear just because a company has more stores. For regulators, long-term investors, and the public market, Luckin still has to prove something every quarter. That the numbers are real, that the governance is real, that the growth is not just another story. In a way, Luckin moved from one kind of risk to another. Before, the question was, are the numbers real? Now the question is, can this enormous transaction network keep running in a healthy way? That is why Luckin Coffee is not a simple success story, because the fraud was real. And it is not a simple failure story either, because the business survived, rebuilt, and became even larger. The uncomfortable lesson is that business does not automatically reward virtue, and it does not always punish mistakes forever. It keeps asking a colder question. Are the customers still there? Are the transactions still happening? Does the system still work? Luckin's scandal is already part of history, but its second life is still being tested. This is not a story about forgiveness. It is a story about business systems, the cost of trust, and the changing shape of China's consumer market. Welcome to Empire Motive. We look for the real motives behind business empires.